When investing in SPY, the when to buy and hold question usually comes down to strategy. There isn't a single perfect entry, but there are a few disciplined approaches that long-term investors use. Dollar cost averaging, DCA, with SPDR S&P 500 ETF Trust means investing a fixed dollar amount at regular intervals, regardless of market price. Instead of trying to time the market, you spread purchases across time. This reduces the risk of buying everything at a peak. How it works. You choose a fixed amount, example $200, a fixed schedule, weekly, bi-weekly, monthly, a long holding period, example, month 1, is for $500, $200 buys 0.40 shares. Month 2, plus $450 or 200 buys 0.44 shares. Month 3, SPY equals 520, now 2 buys 0.38 shares. Your average cost ends up somewhere in the middle, not at the highest price. Why investors use it: removes emotional decisions, avoids waiting for perfect. Entry, automatically buys more during dips, builds discipline and consistency, works well with long-term market uptrend. Frequency choices, weekly, smoother average, more consistent exposure. Bi-weekly, aligns with paychecks. Monthly, simplest, fewer transactions. All three are effective. The key is consistency, lump sum versus DCA. Lump sum often performs better statistically in strong bull markets. DCA reduces risk if markets drop after you invest. Many investors use a hybrid: invest part now, DCA the rest over months. Example 12-month DCA plan. Total capital $12,000. Invest $1,000 per month into SPY. Continue regardless of market direction. Hold long-term advanced DCA variation, value averaging. Some investors increase contributions when markets drop. Normal month, $500. Market down 10%, $750. Market down 20%, $1,000. This leans heavier into dips while maintaining discipline. When DCA works best: long-term investing, 5 to 20 years, volatile markets, regular income contributions, retirement accounts. Common mistakes: stopping when market drops. This defeats the purpose. Trying to adjust every month based on news, switching strategies mid-cycle, selling too early. A simple rule: set it, automate it, and leave it alone. Over time, DCA into SPY smooths entry risk and builds exposure to the broader market. 2. Buy on pullbacks for SPDR S&P 500 ETF Trusts PY means waiting for temporary price drops within an overall upward trend, then entering positions during those dips. The idea is to avoid buying at short-term highs while still participating in long-term growth. What counts as a pullback? Investors typically define pullbacks in ranges. Minor pullback, 3 to 5% drop from recent highs. Standard pullback, 5 to 10% drop. Deeper correction, 10 to 20% drop. Most buy-the-dip strategies focus on the 5 to 10% range because these occur more frequently and still maintain the bullish trend. Basic pullback strategy 1. Identify that the long-term trend is still upward. 2. Wait for a decline from recent highs. 3. Start buying gradually during the drop. 4. Continue holding long-term. Example: SPY makes a high at 520. Price drops to $494, about 5%. First buy, drops to $468, about 10%. Add more. Hold as trend resumes upward. Why this approach works: markets rarely move straight up. Even strong bull markets experience regular pullbacks. Buying during these temporary declines improves your average entry price compared to chasing momentum. Common pullback signals investors use: price returning to 50-day moving average, shorter term support, price near 100-day or 200-day moving average, stronger support. Sharp sell-off followed by slowing downside momentum, market-wide declines rather than company-specific news. Scaling into pullbacks, more disciplined approach. Instead of buying all at once, buy 25% and at 5%, buy 25% at minus 8%, buy 25% and at 10%, buy 25% if deeper correction. This reduces the risk of entering too early. Advantages: better average price than random buying. Still keeps you invested in long-term trend. less emotional than chasing highs. Risks. Pullback can turn into deeper correction. You may wait too long and miss continued rallies. Requires patience and discipline. Combining with DCA, popular hybrid. Invest a base amount regularly. Add extra capital only during pullbacks. This keeps exposure while still taking advantage of dips. When pullback buying works best, bull markets or long-term uptrends. Long investment horizon. When you're adding to an existing position. When it works poorly, during major bear markets, trend is down. When trying to perfectly time exact bottoms. A practical rule many long-term investors follow. Buy small amounts regularly, but increase purchases when SPI drops 5 to 10% from recent highs, then hold for years. 3. Buy during bear markets for SPDR S&P 500 ETF Trust means accumulating shares when the overall market is significantly down, typically 20% or more from recent highs. The logic is straightforward. Long-term returns improve when you buy broad markets at discounted valuations. What defines a bear market? Correction, minus 10% from highs. Bear market, minus 20% or more. Deep bear market, minus 30 to minus 50%. Historically, the S&P 500 has eventually recovered from all bear markets, although timing varies from months to a few years. Basic bear market accumulation plan. Instead of trying to pick the exact bottom, investors scale in as declines deepen. Down 20%, first allocation. Down 25%, second allocation. Down 30%, third allocation. Down 35 plus, final allocation. This approach spreads risk and avoids the need for perfect timing. Example, SPY peak, $500, minus 20% level, 400 by portion, minus 30% level, 350, add more, minus 40% level, 300, add final portion. Then hold through recovery. Why this works. Bear markets create lower valuation multiples, higher future expected returns, panic selling from short-term traders, long-term accumulation opportunities. Investors willing to hold through volatility often benefit when markets rebound. Historical recovery pattern. Typical cycle. 1. Sharp decline. 2. Sideways consolidation. 3. Early recovery, often before news improves. 4. New highs over time. The strongest gains frequently occur early in recoveries, which is why waiting for confirmation can reduce returns. More structured approach. Some investors allocate capital by severity. Use 30% of cash at minus 20%. Use 30% at minus 30%. Use 40% below minus 35%. This keeps capital available if declines continue. Psychological challenge. This strategy is difficult because news is negative, fear is elevated, prices keep falling after initial buys. It feels uncomfortable to invest. However, that discomfort is often what creates the opportunity. Combining with long-term holding. Once purchases are made, avoid selling during volatility. Hold through recovery phase. Continue regular contributions if possible. Risks. Market may decline further after entry. Recovery may take time. Requires patience and liquidity. Best use case. Long investment horizon, 5 to 10 plus years. Cash available to deploy. Comfortable holding through volatility. Many long-term investors treat bear markets as accumulation phases rather than something to avoid, especially when buying index ETFs like SPY and holding through the full cycle. 4. Technical buy and hold triggers for SPDR S&P 500 ETF Trust. Why? Use price-based signals to identify statistically favorable long-term entry zones. These are not short-term trading signals. They're used to improve long-term entries while still planning to hold for years. A. 200-day moving average, long-term trend filter. This is one of the most widely followed long-term indicators. When SPY pulls back to the 200-day moving average, many investors accumulate. If price stays above it, the long-term uptrend is considered intact. If price dips slightly below and reclaims it, that's often viewed as a strong accumulation zone. Typical approach. First buy near the 200-day average. Add if price dips slightly below. Hold once price stabilizes and resumes trend. This method attempts to buy during healthy corrections rather than at highs. B. 50-day moving average pullback, trend continuation. This is a shallower pullback inside strong bull markets. Price touches or briefly dips below the 50-day average. Buyers often step in quickly. Works best when overall trend is strong. Investors sometimes buy partial position at 50-day test, add more only if deeper pullback occurs. C. Volatility spike, fear-based entries. Sharp increases in market volatility often coincide with panic selling. Characteristics: rapid multi-day drops, negative headlines, large red candles. Long-term investors use these moments to scale in because prices are temporarily compressed. D. Support level retest. Markets often pull back to previous breakout levels. Example: CY breaks above resistance, later pulls back to that same level, holds and bounces. This is viewed as confirmation of support and a favorable long-term entry. E. Trendline pullbacks. In sustained uptrends, price respects upward sloping trendline. Pullbacks to that trendline become buy zones, used mainly for gradual accumulation. Combining signals, stronger setup. Higher probability occurs when multiple factors align. Near 200-day moving average, after 8 to 12% correction, high volatility, at previous support level. Investors often increase position size when several triggers occur simultaneously. Example: structured plan. Buy 25% at 50-day pullback, buy 25% at minus 8% correction, buy 25% near 200-day average, buy 25% if volatility spike, then hold long term. Advantages: improves average entry price, keeps discipline, avoids emotional buying, still aligned with long-term investing. Limitations: signals are not perfect. Market may continue lower, requires patience. You may miss some rallies. Many long-term investors combine this with dollar cost averaging. They invest regularly, but add larger amounts when technical triggers appear. 5. The simplest rule, often most effective. Buy whenever you have long-term capital and hold for 5 to 10 plus years. The S&P 500 has historically trended upward over decades, so time in the market tends to beat perfect timing. Typical long-term approach: start buying now, add more on 5 to 10% dips, continue regular contributions, hold through volatility. When not to sell for long-term holders: normal corrections, 5 to 15%, news-driven panic, short-term economic concerns. When investors consider reducing near-retirement risk management, rebalancing portfolio, major change in personal financial needs. If your goal is long-term investing, the highest probability plan is consistent buying plus hold through cycles. If you tell me long-term, 10 plus years, or medium-term, lump sum or adding regularly, risk tolerance, conservative versus aggressive, I can suggest a more precise buy and hold framework. SPY dividend, how much it actually paid. Dividend yield about 1.1%. Annual payout roughly 7.30 cents per share. Payment frequency quarterly. Dividend growth increased for 16 consecutive years. That means $10,000 invested, about 110 year, 100,000 invested, about 1,100 per year. So SPY is not ideal if your goal is income. It's better for long-term capital growth. Better dividend alternatives, higher income. These ETFs focus on income and typically yield 2 to 4x more than SPY. Higher yield dividend ETFs. Vanguard High Dividend Yield ETF, VYM, around 2.5% yield. Schwab US Dividend Equity ETF, SCHD, around 3.8% yield. SPDR Portfolio S&P 500 High Dividend ETF, around 4.5% yield. iShares Core High Dividend ETF, HDV, around 3.1% yield. These yields are significantly higher than SPY's 1.1%. Quick comparison: income versus growth mindset, ETF focus, approx yield best for SPY 1.1%, long-term growth, SCHD dividend growth 3 to 4%. Balanced income plus growth, high dividend 2-3%, stable income, SPYD high yield 4 to 5%, maximum income HDV, quality dividends 3%, defensive income. Which is more valuable depends on your goal. If you want long-term wealth growth, SPY still often wins over decades because price appreciation is stronger. If you want passive income, SCHD is often considered the best balance. SPYD gives highest income but slower growth. VM is stable middle ground. Popular strategy many investors use. Core growth, 60 to 70%. Income, SCHD, or 30 to 40%. This gives growth from SPY, higher dividends from the income ETF. Important trade-off. Higher dividend ETFs usually grow slower. More exposure to values banks, utilities, energy, less tech exposure, but they pay much more income. Simple takeaway. Want growth, Russ? Want income, SC. Want both, mix, SAHD. If income goal, monthly cash, long-term hold years, starting amount, I can suggest an exact allocation.